Welcome to Market Matters. I'm Charlotte Chong, joined by Chong. Now today we have company in the news, AMMB Holdings Bhd, the 6th largest bank in terms of assets in Malaysia, 2nd largest in terms of market share in auto financing. Now this company just announced second quarter earnings drop on both top line and net profit. Yeah,
hard year for banks and hard year for AMMB. You'll have seen that retail banking profit after tax has decreased for them by 9% on the year. It's across the board. Wholesale banking down by 11% on the year. General insurance gross written premiums down by 3.5% on the year. The only bright spark for them was actually in Islamic banking. Where they actually had a 2.8% rise on the year, but with a 10% increase on expenses. So overall, still a tough quarter for them.
Now, the acting MD, Dato' Azmi, actually came out with a press release saying that near-term business conditions are expected to be challenging. Well, it's the same across all the banks. One interesting thing about AMMB is they have not started laying off staff, unlike Standard Chartered, CIMB Bank, Maybank, and also RHB Bank.
Yeah, as well as MBSB and Standard Chartered, as you say, Charlotte. Maybe the operative word there is yet, because I think all banks at some point in time try and right-size their workforce. So I guess being one of the smaller banks in town, maybe their workforce is already appropriate.
Now, in September this year, Star actually ran an article, a very interesting one. The article quoted sources saying that Bank of China, Malaysia Bhd, actually this bank is both listed in Hong Kong and Shanghai. They are eyeing a stake in AMMB. Now, we know that it has been no surprise, the bank industry has been seeing a lot of M&A, merger and acquisitions. But of course, if they want to buy stakes in AMMB, they need to get approvals from Bank Negara Malaysia. Yeah, so what do you think about these mergers and acquisitions going on in AMMB?
I don't think that's going to be the sticking point. I think the sticking point really would be the price, because we've seen recent deals done at the midpoint, 2.5 times book value. Of course, we know that ANZ wants to decrease their stakes in their ASEAN investments. They've got to deal with more stuff back home since the change of the CEO there. They've got 24%. They're the biggest shareholders in AM. They want to get rid of some of that stock. Tan Sri Azman Hashim, who also is the founder and chairman of the company, he's getting old and he wants to get rid and cash out of his business. He also owns parallel stakes in ECM Libra, so he can't have too many financial services stakes. So he wants to pare his stake down. I wouldn't be surprised if Bank of China and AM get together and have a chat early next year. Of course, Bank Negara needs to sort out MBSB's merger with Muamalat right now. So one at a time, I think, they get in the queue.
Now, actually, Bank of China, they have presence in Malaysia, but their presence is not as huge as other banks here. And I understand why they want to venture into this market, because probably they see some potential in this market, and probably they want to get into the Islamic banking world.
Well, I suspect what this deal is all about is for the Bank of China to get into AM and use AM as a conduit through which to do a lot of their funding for their projects in Malaysia. As you know, outward bound investment from China into Malaysia has been huge. They're building ports, highways, bridges, reclaiming land, CRCC, huge projects in Iskandar as well. So, AM might be the conduit.
To take it home, the bank has actually reported lower second quarter earnings across the board, and the MD actually say that they are guided for a challenging outlook throughout the remaining year and also next year. But this bank actually remains a bank which has not cut staff, unlike bigger rivals like CIMB, Maybank and all. Moving on to Broker's Call, today we have Kuala Lumpur Kepong Bhd, brought to you by two research houses, UOB Kay Hian and RHB. Now, this company obviously is a plantations company. They share the same building as us. It closed 0.3% lower at 22 ringgit 62 cents. This company recently announced their fourth quarter results, where we saw revenue and net profit actually increase.
Yeah, interesting, because the crude palm oil industry has been going through a very tough time this year, and for them to have increased top line as well as at profit level. KLK is one of the better run planters, one of the the largest large cap planters out there. They rose as much as 0.5%, 12 cents, after declaring a single interim dividend of 30 cents a share. So it's quite interesting because it's a tale of different interpretations, right? You've got to talk about UOB. I'm going to talk about RHB, and RHB, they have a target price of $25.50 for this stock, which means even though it's such a heavy cap, and even that's such an expensive stock, they reckon there's still about 10 to 15% upside. You talked earlier, Charlotte, about how spot CPO prices are about 2,300 ringgit per metric ton now. They reckon CPO could be 2,500 ringgit per metric ton by the end of next year, early year after that. So being one of the largest cap planters, they would probably be in the best position to rebound strongly when CPO increases.
But bear in mind that the CPO inventory has rose to an all-time high in October this year to about 2.628 million tons, which would actually put pressure into CPO prices as well, and hence palm oil shares. UOB actually has a maintained hold in this company with a target price of 21 ringgit 75 cent. And UOB actually say that the result is actually in line with their expectations. They raised FY16, FY17 profit forecast by 2 to 15%, in factor in higher CPO price assumptions and lower F&B production growth.
So for most retail players, I think KLK would not be on their portfolio because it's just too heavy. If you're a large asset manager, one of the EPFs or corps of this world, if you look at it, 2016 valuations are about 17 times earnings where KLK is concerned. And it might be deemed as attractive. At least that's what RHB thinks. So if you are trying to get in at these levels, $22.62, you got 10 to 15% upside. That's not bad because they're going to be commanding a big weighting in the portfolio.
Now, this company has actually some property as well in their portfolio. But UOB actually said that there will be less excitement from property division in the near term because the next catalyst will only come in their JV project with UEM Sunrise. Profit will actually expected to come in 2 to 3 years' time. So it's not really a big deal now.
It's a tough world for them because they're involved in plantations, which is going through a tough time. They're involved in properties, which is also going through a tough time. So the thing to do for them is to hunker down, make sure they run the firm efficiently, and to sit tight and wait for the sun to shine again.
Net profit actually up 9.1% to 186.3 million ringgit. Revenue up 39.3% to 3.9 billion ringgit. So to take it all home, this company, of course, is involved in palm oil cultivation. Earnings in their property will only come in 2 to 3 years' time. And UOB is pretty not very positive in this company, maintaining a hold with TP 21.75 ringgit. But RHB is slightly more positive than UOB KKN, maintaining a buy call with higher TP of 25.5 ringgit. So thank you for watching. I'm Charlotte Chong, joined by Khoo Chuang. If you need more information about what we spoke about just now, please visit dhmarkets.com or pick up a physical copy of DH Weekly or Daily. Thanks for watching. Good night.